If you're a pensioner and you've noticed an unexpected £300 deduction from your bank account by HMRC, you're not alone, and this could be happening to thousands of pensioners across the UK right now. This isn't a mistake, it's not a scam, and it's definitely something you need to understand immediately because it could affect your financial planning for the rest of the year. The question everyone's asking is simple: why is HMRC taking money directly from pensioners' bank accounts? And more importantly, are you next? Before we dive into the details that could save you hundreds of pounds, make sure to subscribe to our channel and hit that notification bell because we're constantly updating you on the latest changes to pensions, benefits, and tax regulations that directly impact your finances. Trust me, you don't want to miss these crucial updates that could make the difference between keeping your money and losing it to unexpected deductions. So what exactly is this £300 deduction, and why are some pensioners finding their bank accounts lighter without any prior warning? The answer lies in a complex web of tax codes, pension adjustments, and HMRC's increasingly aggressive approach to collecting what they believe they are owed. Are you prepared for the possibility that your account could be next? And do you know what steps you can take to protect yourself? This £300 deduction is primarily related to tax code adjustments that HMRC has been implementing throughout the 2024 to 2025 tax year, but the impact is being felt most severely by pensioners who receive multiple sources of income. Have you checked your recent bank statements carefully? Because this deduction might not be clearly labeled, and many pensioners are only discovering it weeks after it's been taken. The reality is that HMRC has broad powers to collect tax directly from your bank account under certain circumstances, and they are using these powers more frequently than ever before. The most common scenario involves pensioners who have underpaid tax in previous years, often without even realizing it. Did you know that if you receive a state pension, a private pension, and perhaps some investment income or part-time work earnings, the chances of your tax code being incorrect are significantly higher than you might think? HMRC's computer systems automatically calculate what they believe you owe, and if they determine you've underpaid by £300 or more, they have the authority to collect this directly from your bank account through what's called a direct recovery of debt. But here's where it gets particularly concerning for pensioners: the £300 figure isn't arbitrary. It's often the result of cumulative underpayments that have built up over several months or even tax years. Are you confident that your tax code has been correct throughout the current tax year? And have you been receiving all the tax-free allowances you're entitled to? Many pensioners discover too late that their tax code didn't account for changes in their pension income, or that they weren't receiving their full personal allowance because HMRC's records were outdated or incorrect. The process typically begins when HMRC sends what they call a final demand notice. But here's the problem: thousands of pensioners report never receiving this notice, or receiving it so close to the deduction date that there wasn't sufficient time to respond or dispute the amount. Have you been keeping track of all correspondence from HMRC, including letters that might look like routine tax code notifications but actually contain crucial information about potential deductions? The frightening reality is that HMRC can proceed with the deduction even if you haven't received or responded to their notices, as long as they can prove they sent them to your last known address. What makes this particularly unfair for pensioners is that many are living on fixed incomes and have carefully budgeted their monthly expenses around their expected pension payments. When £300 suddenly disappears from your account, it can create serious financial hardship, especially if it happens at a time when you're already dealing with rising living costs and energy bills. Can you imagine the stress of having your carefully planned budget thrown into chaos by an unexpected government deduction that you weren't prepared for? The types of pensioners most at risk include those who have recently retired and are still adjusting to their new tax situation, those who receive income from multiple sources including rental properties or investments, and those who have moved house recently and may not have updated their address with all relevant government departments. Are you in any of these categories? And if so, have you taken steps to ensure your tax affairs are completely up to date and accurate? Another group particularly vulnerable to these deductions includes pensioners who have recently started receiving their state pension while still working part-time or receiving private pension income. The interaction between different income sources can create tax complications that HMRC's automated systems struggle to handle correctly, often resulting in underpayments that the taxpayer is completely unaware of until the deduction appears in their bank account. How confident are you that HMRC has correctly calculated your tax liability across all your income sources? If you've already experienced this £300 deduction, you're probably wondering what you can do about it and whether you have any recourse. The first thing to understand is that you do have rights. And HMRC's ability to take money directly from your account isn't unlimited or beyond challenge. Have you contacted HMRC immediately after discovering the deduction to request a full breakdown of how they calculated the amount owed? You have the right to see exactly how they arrived at the £300 figure, and in many cases, pensioners discover that the calculation contains errors or doesn't account for allowances they should have received. The appeals process exists, but it's time-sensitive and requires you to act quickly once you discover the deduction. Did you know that you can request HMRC to refund the money while your appeal is being processed, especially if the deduction has caused you genuine financial hardship? However, you need to provide evidence of your financial situation and demonstrate that the deduction has created difficulties in meeting your essential living expenses. For pensioners who haven't yet experienced this deduction but are concerned about the possibility, there are proactive steps you can take to protect yourself. The most important is to regularly review your tax code and ensure it accurately reflects your current income situation. When was the last time you checked that your tax code is correct for all your income sources? And do you understand what each part of your tax code means? Many pensioners simply accept whatever tax code HMRC assigns without questioning whether it's appropriate for their circumstances. Another crucial protective measure is to ensure that HMRC has your current contact details and that you're receiving all correspondence they send you. Have you moved house in recent years and forgotten to update your address with HMRC for all your different income sources? A surprising number of these unexpected deductions occur because pensioners haven't received important notices due to outdated address information. It's also worth considering whether you should be completing a self-assessment tax return, even if you're not currently required to do so. While most pensioners with straightforward income sources don't need to complete self-assessment, doing so can give you much greater control over your tax affairs and reduce the likelihood of HMRC making incorrect automated calculations. Are you aware of the circumstances under which completing a voluntary self-assessment might protect you from unexpected tax adjustments? The broader context of these deductions is HMRC's increased focus on debt collection and their expanded powers to recover money they believe is owed. Over the past few years, the government has given HMRC additional tools to collect unpaid tax, including the ability to take money directly from bank accounts, and they are using these powers more frequently than ever before. Do you understand the full extent of HMRC's powers to access your financial accounts? And are you taking appropriate steps to ensure your tax affairs are completely in order? What's particularly concerning is that these deductions can happen with relatively little warning and can affect pensioners who have always tried to pay their taxes correctly but have fallen victim to systemic issues with tax code calculations or administrative errors. The £300 figure represents a significant sum for many pensioners, and the timing of the deduction can create serious problems if it coincides with other planned expenses or financial commitments. If you're worried about the possibility of facing a similar deduction, the best advice is to be proactive rather than reactive. Contact HMRC directly to request a review of your tax position and ensure that your tax code is correct for the current tax year. Ask them to explain exactly how they've calculated your tax liability and whether there are any outstanding amounts from previous years that might result in future deductions. Have you taken advantage of HMRC's helpline specifically designed for pensioners, which can provide guidance tailored to your particular circumstances? Remember that you have rights as a taxpayer, including the right to understand how your tax has been calculated and the right to challenge decisions you believe are incorrect. If you've been affected by this £300 deduction, don't simply accept it without question. Gather all your financial documents, contact HMRC for a full explanation, and consider seeking professional advice if the amounts involved are significant or if you're struggling to understand the complexity of your tax situation. The key message for all pensioners watching this video is simple: stay informed, stay proactive, and don't wait until you see an unexpected deduction in your bank account to start paying attention to your tax affairs. These £300 deductions are happening to real people right now, and while some may be justified, others may be the result of errors or miscalculations that can be corrected if you know how to challenge them effectively.